Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Today, we're going to talk about Wells Fargo, who decided they are going to step back from the mortgage market. And they're not just going to step back from doing mortgage loans. They're going to step back from doing the servicing,
Right.
which is huge. Now, Juana, why is this a big deal? Because, why are they doing this? They were number one in the nation in, I think, 2019. And I think last year they were number 3 behind Rocket Mortgage and United Wholesale Mortgage.
Right. So Wells Fargo is kind of like the 500-pound gorilla, right?
Okay.
So they're very big. They have a lot of the business, but because the mortgage business has changed, it requires a more nimble approach.
Okay.
And a large organization like Wells Fargo is less able to adapt quickly to a changing environment, which is what we've seen in the last few months. And not only that, but Wells Fargo has had a lot of other challenges since 2016,
Okay.
as far as the way they dealt with consumers and the accounts and that sort of thing. So
lending practices.
Lending practices. So I think that they've looked at their whole business and they've said, look, let's kind of pare down to the part of the business where we make money, where we're good at it, and where our exposure to liability is the least.
Okay. They specifically, though, so with mortgage lending, they're still going to lend to consumers that are part of their wealth management, private banking.
Right. So they will still do retail loans. So they will still, if you have a Wells Fargo account, they will still loan you money. They will still do commercial. They will still do, they'll still work with their wealth management clients. They'll still deal with their investment clients. So they're just paring down to the clients that they know the best so that they can go ahead and do the best business they can do and have the best margins. This also allows them to shed a lot of the cost.
I think that's the real reason.
Right. So the mortgage business is people intensive. And so they already did a lot of layoffs last year. Some people left of their own free will. Some people were laid off. And they're going to be doing some more of that this year as they pare down this business. It's going to take them probably a couple of years to divest of all their servicing and all of this going on. But by the time it's all said and done, Wells Fargo should be a leaner, more focused organization and a more profitable organization, which at the end of the day, that's what they owe their shareholders.
They were probably making a lot of money. A lot of lenders flat out went out of business, smaller national lenders who were just doing refis. The lenders that were 80% of their business was refis are all gone. Those lenders have all disappeared. And you have the ones kind of everybody knows, like Rocket Mortgage used to be Quicken Loans, and they're it's mostly online. All their lead generation is online. So they really don't have a lot of front end people. You do most of that virtually. They're just cranking out. So it's more of a tech company. So they're more focused. And then those other companies don't try to also capture the servicing, because servicing is super labor intensive too.
It is.
And what is it? So when they say servicing the loan, what does that mean? What's loan servicing?
So that's really interesting. So loan servicing is, these are the companies that collect the mortgage payment and then disperse the money out to the investors, to, if they pay your property taxes or they pay your homeowners insurance, things like that. So that's what loan servicing does.
Okay.
And anybody want to know how much loan servicing costs? Take a guess. So put in the comments. What do you think? Do they, how much do you think that those fees are? Let's go on a monthly basis. What do you think?
So you have, let's do some. So you have we'll just say you have a $1,500 a month mortgage payment that has to be processed every month, and then every year the homeowners insurance has to be paid, the taxes paid, maybe quarterly, maybe annually. They have to track all this and everything. They have to send you out notices when you're late to say, hey, you're late. So how much does the mortgage servicer make for doing this? Because remember, the mortgage servicer it's almost never the one who holds your mortgage. They're just servicing doing the escrow paperwork, impound account. And then there's some investor on the back end who's actually the one who bought your loan, that's in some pool of other loans who they send the check to over there.
Right. So did you guys guess? Okay. So I'm going to give you kind of a number. So I've kind of looked at this. Loan servicers charge about $12 to $14 a month. So it's kind of an interesting amount of money. I don't know if that's a lot or a little. Of course, when you're talking about volume business, that's a lot of money.
Yeah.
But
I mean, Netflix charged, they were charging that, 5 years ago, right?
Right. But,
$13.
Like Todd said, they do have some work to do. And there's also quite a bit of liability on their part as far as, paying your property taxes on time. If they don't, then they have to pay whatever the fine is for not paying your property tax on time and things like that. Mm-hmm. So there is some liability. And I think that's what Wells Fargo is looking to do, is they're looking to shed any liability they can, and they're just looking to move forward with the profitable parts of their business that really limit their liability.
The other thing too is they built these mortgage origination and mortgage servicing to have a funnel, mm-hmm. and they're losing their funnel. So what they're doing is they're taking out the whole pipeline. Mm-hmm. That whole vertical is disappearing. Let's see, what are they profitable at? They're profitable at consumer banking. Right. What's consumer banking? What does that mean, consumer banking?
So your checking account, your savings account, anything that, depositing your checks on your smartphone, doing your online banking, that sort of thing. They're good at that.
Going into the branch.
Right, going to the branch. They're good at that.
They charge you $30 or $40 for a wire transfer.
Right. So, I think Wells Fargo has one of the better mobile apps as far as banking is concerned. So that's something that they do a good job with. They do a good job of loaning to their existing customers because they know their existing customers, right? Not only that, but then they get paid by their existing customers because their existing customers have accounts with them.
Yeah, you can't default on them. They can just take your money.
Right. That's right. Wealth management. Wealth management is fantastic. It's a great business for them.
What's wealth? What does that mean? Wealth management?
So wealth management is maybe you have your IRA with them, or your 401k with them, or your money market, or your brokerage account, all of those things with them. So again, they're hanging on to all your money. They know all of your transactions. So you are a very good client for them, and certainly they know you very well as far as your assets, and they're capable of loaning you money. And so those loans they will continue to do. And
a lot of that stuff seems to be tech enabled.
It is
like they just have some background person who's crunching numbers and trying to manage your portfolio with a bunch of other people's mm-hmm. portfolios that are in the same risk category as you. So they don't have, they can take hundreds of millions, billions of dollars mm-hmm. and manage it with a smaller group of people than mortgage servicing, which is originators, processors, underwriters, mm-hmm. the people doing the the servicing of the loan and all those.
Right.
So it's super labor intensive.
Right.
It's all office jobs. The other thing too is they have to lease all this office space because mm-hmm. these people probably don't work from home. They probably physically go into an office because they're confidential consumer information, yada, yada.
Right. So what Wells Fargo did, I think, is that they looked at other banks like JP Morgan Chase and things like that. And they said, hey, what are they doing right? And do we want to, not reinvent the wheel, rather, but just copy kind of what they're doing. So that's a lot of what they've done, is they've looked at banks like JP Morgan Chase and said, hey, this is what they're doing. We want to do something similar.
This is normal in all markets, whether it be banking or airlines or oil companies or whatever. When things get tight, a lot of people tend to leave the business, merge, mm-hmm. because it's hard to compete when you have slim margins, and you have very slim margins. It was much easier for these banks and lenders to make money when interest rates were low because they're borrowing money pretty cheaply, and they were freer to do loans. Mm-hmm. Now the interest rates are higher, they're competing even more aggressively. So the spread that they make on a loan is less than it used to be. And not only is the spread less, but the tech-enabled companies like UWM and Rocket Mortgage have an advantage because they don't have more overhead to deal with. So
right. The other thing is the number of transactions. And we've talked about this before. They're doing less transactions because there are less mortgages being taken out, because there are less real estate, there's less real estate transactions being transacted. So all of this kind of plays into it. Like with any business, there's economies of scale. So when they were doing lots of mortgages, that made sense. Now that they're doing considerably less, because everybody's doing considerably less now, it really doesn't make sense anymore.
Now, what does this mean for someone who's going to buy a house next year?
So if you're already doing business with Wells Fargo, then Wells Fargo is one of your choices for a mortgage company.
Okay.
If you are not doing business with Wells Fargo, then if you are interested in Wells Fargo products, you may want to open up an account with them.
Yeah, I don't know that they're like the greatest game in town. They're just they do a lot because they have a lot of connections with real estate companies and these other companies that use Wells Fargo they're Wells Fargo backed companies. So there are mortgage companies out there, Banana Mortgage, backed by Wells Fargo. Mm-hmm. So Banana Mortgage does a deal, it's Wells Fargo underwriting when Wells Fargo grabs and does the thing. They used to do joint ventures with real estate companies, but they had to get out of that because there was a lot of scrutiny. This was back in the 2013-14 timeframe. They all had to divest because every big real estate company had basically a joint venture mortgage company, and the agents at those real estate companies would force their deals to Banana Mortgage. And I just make up the name Banana Mortgage, but then Banana Mortgage was actually 51% owned by Wells Fargo.
Right, but even to that point, Wells Fargo is not going to be participating in those kinds of businesses any longer.
They're gone. They're pulling back, focusing on core things.
Yeah, they're not interested in that, and it doesn't mean that Wells Fargo won't come back to that. But at this point, they have reevaluate how they want to move forward, and this is what they've chosen to do.
This is probably good news for Rocket Mortgage, who's right now I think UWM is now number one. So UWM's number one, Rocket Mortgage number two.
Mm-hmm. So it does limit consumer choices. So I do get concerned about that because obviously the more choices we have, the more competitive the market, and the better it is for consumers. So we'll see how all of this kind of hashes out, but my general sentiment is that when there is limited consumer choice, that is an opportunity for a new player in the field.
Okay.
So if you like the video, if we gave you information that was interesting, useful, if we entertained you, if we made you laugh, if we made you think, please leave us a comment. Please subscribe, hit the notification bell, like the video, share the video, and we'll see you on the next video. Bye.
Bye.